Okay, now we're continuing our discussion of AUC Section 315, understanding the entity and assessing the risk of material misstatement. And so as we saw in the last video, we kind of had an overview of our process of how we are going to understanding the entity's internal control. So now we're going to kind of dive into this section here, A49 through 74. So we see here that we should obtain understanding of the entity's internal control that's relevant to the audit. And as we discussed last time, not all of their controls related to financial reporting are actually going to be relevant. So we'll learn about what a relevant control would be coming up next. But as with most things in the audit, it's up to our professional judgment to determine what is relevant. So let's go down to A49 and A74 to understand a lot more about how to do this. Okay, so now we're down in the explanatory material section, A49. So as we saw before, we're going to be going through A49 through A74, and there's a lot of information here. So we're going to do a lot of different videos, part 1, 2, 3, 4, so on and so forth. But first we see here that understanding the entity's internal control helps us to identify types of potential misstatements and factors that affect the risk of material misstatement and in designing the nature, timing, and extent of further audit procedures. So if we understand their internal controls and where it's likely that the controls aren't designed or implemented properly, then we could say that it's more likely that there will be a misstatement come out of that transaction class, for instance. So this section is going to help us to understand how to do that. And they have 4 different sections that we will go through as part of this. And the first one will be the general nature and characteristics of internal control. Then we'll learn about how to determine the controls that are relevant to the audit, and then the nature and extent of understanding of relevant controls, and then understanding the components of internal control, which is the control environment. And so the first of these is the general nature and characteristics of internal control. So first here, they tell us the purpose of internal control. And so internal control is designed, implemented, and maintained to address identified business risks that threaten the achievement of any of the entity's objectives that concern the reliability of the entity's financial reporting, the effectiveness and efficiency of its operations, and its compliance with applicable laws and regulations. So basically, we're looking at the entity's business risk, and then the entity should have things in place that prevent those risks from turning into a problem. And of course, the way that an entity designs its controls and implements them depends largely on the size and complexity of the entity. If it's a small entity and maybe not a whole lot of complex transactions, then their control environment might be relaxed, and that's okay. A more complex entity, for instance, that maybe has a board of directors and several layers of supervisors and such, might have a more complex control environment, and that's good too. And also within smaller entities, the entity may not have big narratives of their controls or appropriate segregation of responsibilities, or duties, but the owner manager's participation in the business may be a control in itself. So even though an entity may not have a complex, intricate matrix of controls for everything, its control environment may still be sufficient for the size and complexity and the purposes of that entity. And also what they describe here, which is very important, is that internal control, no matter how effective, can provide only reasonable assurance about achieving the entity's financial reporting objectives. So even if the entity has stellar control environment, there's still a risk that the entity could make a mistake and record a wrong amount or offer credit to someone that was unable to pay. So that's why we will find in other sections that even if we test the internal controls and they're all perfect, we still have to do substantive procedures to make sure that the account or transaction class or disclosure is accurate, because we can't just rely on the internal controls. There's still human error, for instance, that might happen. Also, which is very important, is that controls might be circumvented by collusion of 2 or more people or inappropriate management override of controls. So even though controls might be operating great, there might be some kind of fraudulent activity by people in the company that would undermine those controls, or management comes in and tells its staff not to do that control. And so next we have a description of the 5 internal control components, and later on we'll go into each of these in detail, but I think at this point they're just kind of familiarizing us with what these are, because these in the audit we will certainly approach each of these individually as we are understanding the entity's internal controls, but for now they're just providing a list of them. And this provides us a framework to use when we're understanding their controls. So first would be the control environment, then the entity's risk assessment process. Note, this is not our risk assessment process. This is the entity assessing the risk that the business risk, for instance, that the financial statements might not be recorded appropriately, or certain objectives that the entity wants to accomplish might not be met. So this is the entity's risk assessment process. Also, their information system, which includes their business processes relevant to information reporting and communication. Their control activities, so these are the actual individual controls that are being used. And then monitoring of the controls, so kind of following up to see, are these controls acting appropriately or achieving the objectives that they're intended to, and if not, they need to change or improve or update them. And so we're required to look at each of these components when we're understanding entities internal control. We don't necessarily have to use the exact terminology, but we have to consider each of these. And so we will learn about each of these in A78 through A121, so that will be in a future video. And another thing we need to consider when we're gaining an understanding of the internal controls is that, especially these days, a lot more things are automated. So a lot more controls are automated versus manual. And so this is very much very relevant to our understanding of the internal control. The automated controls might not have the human element within the controls per se, but the design of those automated controls would be important for us. And so whether or not the controls are manual, for instance, an individual employee comparing a PO to an invoice or whatnot, or whether the computer automatically compares the PO to the invoice, we still have to look at this from the perspective of the 5 components as if they're not different. So some of the ways that these manual versus automated controls are different might be that in a manual system, procedures for approvals and reviews of transactions and reconciliations and follow-up of reconciling items might be done by a person. However, and using automated procedures to initiate, authorize, record, process, or report transactions, these all might be digital instead of paper documents. And IT and manual functions might work together. IT might initiate certain functions and controls, whereas the manual might initiate IT functions and such. So we have to understand how all this works together. And that, of course, depends on the nature and complexity of the entity's use of IT. And IT generally benefits an entity's internal control by enabling them to consistently apply predefined business rules and perform complex calculations, large processing volumes. It helps by enhancing the timeliness, availability, and accuracy of information. It helps to facilitate additional analysis of the information. It helps to enhance the ability to monitor the performance of the activities and policies and procedures, helps to reduce the risk that controls will be circumvented, and it helps to enhance the ability to achieve effective segregation of duties. However, there are some risks with using IT for internal controls too. That would include reliance on systems or programs that are inaccurately processing data, unauthorized access to data that could result in destruction of it, or authorization of transactions or inaccurate reporting. And if the IT personnel had privileges that were beyond their duties, then that would certainly break down the segregation of duties goal. There could also be unauthorized changes to master files and systems and programs, or even the failure to make changes to programs when there's supposed to be changes. So even though the intention of IT might be to automate a lot of processes and create some good internal controls, there are still some risks related to those, to IT, and we have to understand what those are when we are developing our audit plan. And certainly a manual internal control process is more suitable when judgment or discretion is required, for instance, in large, unusual, or non-recurring transactions, or circumstances where errors are difficult to define, or changing circumstances, or when monitoring the effectiveness of automated controls. So until computers are able for critical thinking or analysis, humans still manually need to manually process the controls for these types of transactions, and also to monitor the effectiveness of the automated control. And of course, the failure of manual controls is that it's hard to be consistent because these controls can be bypassed, ignored, or overridden. And they're also prone to simple errors and mistakes. So, of course, with automated controls with IT, it kind of solves all of these pieces, but manual controls still need to be in place for these items.